Good afternoon, everyone. Thank you for joining us this afternoon for the Metalla Royalty and Streaming Update webinar. My name is Kristina Pillon, Investor Relations for Metalla. I am pleased to introduce our President and CEO, Brett Heath, who will be presenting on behalf of the company today. Also, Vice President of Corporate Development, Drew Clark, Corporate Development Associate Sara, CFO Saurabh Handa, and Non-Executive Director Heath Tucker. Brett will give a brief update on Metalla and followed by a few slides by members of the team, followed by a Q&A period. If you have any questions, please submit them in the Q&A window on your screen, and we will try to address as many as time permits. If we're not able to answer your questions today, please feel free to reach out to me at info@metallaroyalty.com. A recording of this webcast will be posted to our website and shared via Twitter and our LinkedIn accounts. And a copy of our investor presentation is available on the website. With that, Brett, over to you.
Thanks, Kristina, and good afternoon, everyone. Again, thank you for joining us today for our October 2021 Metalla Royalty webinar. We've got a lot to cover today. We're going to be going through a couple recent, very exciting acquisitions. We've got several asset updates that we're going to touch on. We're seeing some very significant advancements in some of our portfolio assets. And we'll also hear from E.B. Tucker, author of Why Gold, Why Now? But before we get into that, we've been hearing a lot about a specific topic that I'd like to discuss and I think how that plays into our company. And if you're a royalty investor today, you're probably well aware of this topic. That's M&A, that's mergers and acquisitions. We have seen a bit of an uptick recently in the sector, and mergers and acquisitions, or M&A, is a healthy thing. We live in a world today where there are more royalty companies that ever existed. At the same time, we're seeing probably some of the most competitive environments for assets that we've also ever seen. I mean, really, it's a perfect storm, and we believe that trend is likely to continue over the next 1 to 2 years. Now, what's important to understand is as an investor is how the company that you're invested in is positioned for this period. And there's 4 points of what I believe is strength that Metalla possesses that I think is going to allow us to be able to not only navigate, maximize the opportunities that come up, but really be able to benefit over the next 2 years. And the first point that I want to share with you, and these are points that you can really compare across the whole sector to any royalty company or gold royalty company that you're invested in. But the first one is really deal flow. You got to be able to have your own sourced deal flow. Just this year, again, in what has been one of the most competitive years that I've ever seen, Metalla has done a record 7 acquisitions this year. The year's not even over yet. We did that through the first about 9 months of the calendar year. And these are acquisitions on multi-million-ounce deposits across proven geological trends that are being advanced by the largest mining companies in the world, the types of acquisitions that you want. But most importantly, these were sourced bilaterally. That means just the company and the seller of the assets, which is how we've been able to deliver a lot of accretive value to you as shareholders. Another important point is really the float and liquidity of the company that you're invested in. At Metalla, we've been able to build and control our capital structure. We've got upwards of 90% float in our company. And what this means is that we've got no big chunky shareholders. Our largest shareholder is the GDXJ at just over 5%, and then BD Capital, who we have a very, very close working relationship with. They've been just an incredible shareholder and have really supported us through our growth phase over the last few years. But what that does is it allows the company that you're invested in really to be in the driver's seat, because big chunky shareholders sometimes don't have the same interest as the common shareholder in these companies. So that's another very significant or position of strength that I think that we'll have through this coming period. The third is the growth. Having the built-in growth is so important in your business. over the last 5 years, through the 27 public transactions that we've completed, acquiring 70 royalties, we've always focused on growth. And that really, the value that we saw was really in the development side of the business. These are royalties that are on development assets. Again, most of them with the same characteristics across the proven geological trends being advanced by these major mining companies. But this was done for a purpose, because now we have the growth built in. We don't have the pressures that some companies would have in periods like this, where they may be forced to compete in competitive processes that can often result in capital destruction for shareholders. And the fourth, or the last but not least, is access to capital. It's so important to have as many possible tools as you can in your toolbox to be able to use at the specific time that's really going to be able to, you're really going to be able to pull on the different tools to be able to maximize the value for your shareholders. And this year, 2021, we have deployed more capital than we have in any other year in our business. And we've been able to do that through utilizing our convertible facilities with BD Capital. We've been able to raise over 30 million US in the last 12 months through our ATM facility. That's our at the market facility, which gives us the flexibility to cross in vetted institutional shareholders that are not only there to help support the company today, but we believe will support the company in the future. And so all of these are big value adds as we move into this new environment that I think we're already seeing the early signs for. So we're really excited about the rest of this year. 2022, I think, is going to be even bigger. And we hope that you as shareholders are excited as well. So with all that said, I will pass it off to our corporate development team, Drew Clark and Sunny Sara, to walk you through the recent updates here that we're going to cover today.
Hi there. I have everyone to look at the forward-looking statements. It's standard language, but should be at least prefaced before we get into our conversation. As Brett mentioned, this year was our busiest yet. Here's a look back in the last 12 months. We've done 8 transactions, bringing in 17 royalties. In aggregate, we deployed 74 million in capital. And if you add up all of the consensus analyst estimates for the net asset value of those, it works out to a little over 114 million. If you back that out, that works out to about a price to NAV of 0.65, which is relevant as a lot of our peers are deploying capital in the 1 to 1.2 times range. One thing I would highlight, though, is of these 8 transactions, 6 of them were on $1 billion plus top tier operators. And as Brett is going to wrap up later in the presentation, you'll see that the prices are consistently below what our peers are paying, which is not the norm for assets with such great counterparties. I'm going to quickly highlight some of the deals we've done since our last webinar, along with Sunny, who works with us in the corporate development group here, along with some very noteworthy developments in the portfolio. But if anyone really wants to get in more depth, contact myself, Kristina, Brett, anyone, or you can refer to our MD&A. Every quarter we put it out. It's a very comprehensive, if not exhaustive, list of the entire portfolio of 70 royalties, where we track these very closely and update them as they come along. The first, and I guess the most noteworthy deal that we did was just over a month ago. I think it was a month ago and a day, was the Castle royalty, which we paid $15 million US for. It's a 5% NSR on what will be one of the top 10 gold mines when it's ramped up in the next 5-6 years. It's being operated by the team at Equinox, one of the fastest growing mid-tiers in the game. It's got a very noteworthy chairman, Ross Beatty, one of the most prolific mining entrepreneurs. And what we're excited about this is not only is it being pushed forward and already on an operating mine, we believe there's a real opportunity to join the 2 pits, which where we have a royalty on South Domes, and also ultimately move it forward in the production plan. 2 years ago, roughly in April 2019, we acquired a portfolio of assets from Alamos. Since we acquired that portfolio, one of the sort of flagship royalties within it was an asset called Wasamac. We have a 1.5% royalty on it. we're really excited about it. Since acquiring the project, Yamana has expanded the reserve, expanded the throughput, and made a discovery. And they just acquired the project in the summer. They're now talking about running at 200,000 ounces a year for over 15 years or more at the asset. When we bought this off Alamos, it was slated for 155 to 160,000 ounces over roughly an 11-year mine life. So they see potential to grow the asset, increase the production profile, and really aggressively drill it. They're going to do almost 70,000 meters in the next 18 months. It's a great example of where the royalty model comes into play for shareholders. This is obviously no cost to any of us. The last one I'd like to highlight here is the Tocantinzinho mine. This we acquired originally when Eldorado had it. Since we acquired the royalty, a group called G Mining acquired the asset. Now, for those who don't know who G Mining is, this is under the stewardship of Louis Gignac. He's built 4 mines, some for Newmont, most notably the recent one was FDN for Lundin Gold, each time under budget or on or ahead of schedule. So these are proven mine builders that are buying what is now their flagship asset. 10 days after they bought the asset, they did a bought deal, really well subscribed, really good institutional following. They're building this mine ahead of schedule as to where we thought it would be when we originally bought it. Very quickly on the exploration ground here, as you can see on the slide here, it's really been untouched in terms of the property package. Less than 5% of almost 700 square kilometers has been drill tested. And below the current pit shell, they've had some absolutely great holes that are probably going to push this thing a little bit deeper without even stepping out or getting too aggressive with the drill bit. I'm going to hand this off to Sunny Sara, who's going to go into some of the other assets.
Thanks, Drew. So earlier, or a few months ago, we announced the acquisition of a 1.35% royalty on the Côté mine. This is IAMGOLD's next development asset. It's currently in production as a 7.2 million ounce reserve estimate, and is expected to do about 500,000 ounces a year beginning in 2023. Our royalty covers about 6% of the reserves, and our royalty also covers the Gosselin zone. So in the anticipated mine life of the Côté deposit, the production decreases from about 500,000 to 370,000 ounces a year. And IAMGOLD is hoping to supplement the mill with the Gosselin ore, where they're hoping to release a resource estimate of about 3 to 5 million ounces of gold. And recently they've released some drill results where they've had a large amount of successful drilling where they've hit holes of 0.95 grams per ton over 430 meters, 1.41 grams per ton over 393 meters. And just moving on to the next slide, Drew, please. You can see that when they originally released the 3 to 5 million ounce resource estimate or exploration estimate in March, on the left side, the block model was a lot smaller, and exploration drilling has shown that this thing just continues to get bigger, and it's starting to look like it's getting very close to the Côté pit. So there is potential that, or we think there's potential that this could become a very large pit, perhaps even a super pit. And just some recent developments going on to some of our assets on the next slide. Recently, the Agnico Eagle and Kirkland Lake merger has provided some synergies for Metalla as well. The amalgamated Kirkland royalty is one that we acquired for about 700,000 Canadian earlier this year. It has about almost a 700,000 ounce resource estimate, and this AK ore body is almost 100 meters away from the South Mine Complex at Macassa. So there's immediately synergies for Agnico Eagle to go and mine this, and the grades are very similar. It also brings up the potential for exploration upside at the South Mine Complex way underground, as it seems that the ore body may be venturing off onto the AK property as well. Other developments include the Wharf mine. Recently completed a site visit there. They've been producing and hitting their targets, even exceeding them at 85 to 95,000 ounces of gold a year. We hold a 1% GVR there that is currently producing, and they've had some great drill results infilling some of the resources to potentially extend the mine life. Some of these hits include 7.5 grams per ton over 36 meters and 4.1 grams per ton over 61 meters. And as Drew has mentioned before, our MD&A has a lot of our updates on some of these assets. Some other noteworthy ones include Aurelito, where there is pre-stripping activities that have begun. So open pit mining will soon begin. And at Santa Gertrudis, where there have been some high grade discoveries that they've highlighted some really good drill results from as well. So I think next I'll move it back to Brett.
Over to you, Brett.
Thanks, Sonny and Drew, for the asset updates here. I mean, obviously we've got some great things going on, and you know, we hope that you guys are just as excited as we are. But you know, again, you know, we want to point out we've been able to execute on just some incredible assets, and that is really kind of the key. You know, being able to buy high quality deals at accretive prices. The chart that you see, or the graph that you see in front of us here, is just the last couple of years of acquisitions that we've had. You'll notice the royalties are again across a very diversified blend of some of the largest operators. More importantly, consistently at accretive prices as these things are continuing to be advanced. And so this is what we've set out to deliver from the very beginning across all 27 acquisitions. And this is what we'll continue to deliver over and over again as we continue growing our business and adding value kind of one asset at a time as we grow here. A new chart that we put together, if we can flip to the next page, is really highlighting the growth here that we have and why we're so excited about everything that we've done over the last 5 years. And what you'll see here is, you know, obviously we've got 5 assets that are producing. Those have all been going very well. But the bulk of the value here is really in the growth. Again, it's the growth that's built in already, that's paid for. We're seeing huge amounts of organic growth on top of this, but right here is the gold equivalent production of upwards of 24 assets. So you've got upwards of 24 assets that are being advanced by the largest gold companies across some of the most well-known, proven gold deposits in the world. And these assets are advancing in production. You know, we should see a different asset come online every single year for the next decade. And just over the next 5 years in our portfolio today, based on the guidance from these larger operators, you know, we could see upwards of 20,000 ounces a year of gold equivalent production. So we're really at the stage of this company where we've got a huge amount of growth. Again, all of that growth is paid for. Almost every single one of these projects is being self-financed by these majors. This is what you want to see with your royalty company. You don't want to see financing risk. You don't want to see the risks that you typically see with smaller operations and smaller mining companies. You want to see the Newmonts, the Yamanas, the Equinoxes, the Coeurs, the Barricks, the Pan American Silvers. These companies know how to build mines, they know how to generate value, and we're buying royalties on projects that are in their pipeline that they're spending significant amounts of capital on. And really it all comes back to the bottom line for our investors. So thank you all for listening to this update. I'd like to pass it over to EB here to see what his latest thoughts are on the markets.
Hi, everyone. Thanks for joining the webinar, and thank you, more importantly, for being a supportive shareholder of Metalla. I thought I would just kind of tell you about something I read recently that I really enjoyed. There's a guy that recommended Metalla in his newsletter. His name is Chris Weber. Weber Global Opportunities, and he took a segment of an article that Richard Russell wrote years ago about the difference between a wealthy man and a wealthy woman, regardless of gender, and someone that just has some money. And he goes into detail and he explains that most, as we all know, most people lose money in the market. The most successful people on the average are people that have an account and forget they have an account. And they've done studies where the people, they forget to log in, and 10 years later, the account's up a lot because they didn't mess with it. And so Richard Russell, he's since passed, as everyone knows, but he wrote this piece about the mindset of the wealthy investor and how if you're getting started, what you want to do is you want to emulate the wealthy investor, do what the wealthy investor does, think like the wealthy investor, and kind of pattern your decision-making like the wealthy investor, because the investor that just has a little bit of money tends to be very jumpy, struggles with patience, wants to buy something that's very hot so that he can tell people that it's hot, and they'll be excited and they'll think more of him. Think, boy, are you smart? You bought the latest crypto coin or something, and that mindset tends to over time to create a lot of trouble, for building and growing wealth. And so the reason I share that is because Brett and I put this company together. I mean, just in fairness, Brett's done all the actual hard work. But when this was 5 years ago, when this was starting, the idea here was to build the company that we wanted to put our own life savings into. What company do we want to own? How do we want exposure? We've been in this business a long, long time, and you can't find exactly what we're looking for. We can't go back to 1987 and buy Franco Nevada or something, or we can't go back to 1999 and buy Royal Gold. It's not possible. The business has changed for those companies. How can we create something that we want to own? And I'm trying to explain all the time to people that I'm close with in my life that ask me this question. And you don't want to own something that's hot, and the message board people are thrilled about it because you bought the hottest deal from the most popular, seller in Toronto or something, and you got a nice headline, and everybody's going to get involved in your stock, and then they're going to sell it, and it's going to go down. You've seen this 100 times. What you want is you want to have exposure to hundreds of thousands of ounces of gold locked in the ground that companies are going to slowly bring up over the next 30 years or so. And as the costs rise, which we all know that inflation's rising. I just did an interview earlier today with Stansberry Media. It'll come out tomorrow. Hope you'll all see it, where we talk about she keeps asking me, well, the Fed says inflation's transitory. Yeah, well, what do you say? Do you use gas? Do you have a power bill? Do you go to the grocery store? I mean, do you eat food? I mean, what do you say? You're more important than the Fed. Who cares what they say? There's never been a time when they've warned you about something, and it's been a prescient warning. Never once. They didn't warn you about the housing crisis. They didn't warn you about the tech stock blow up. They didn't give you a tip to buy Bitcoin when it was $1. They didn't do anything to help you. But now all of a sudden they tell you, don't worry about the inflation. And you say, well, I'm not worried about the inflation. Well, so what we're seeing, and we're seeing this all around the world. I mean, you can look at Argentina, 50% inflation, 35% interest on government bonds. In the US, it's 5 or 6% inflation, maybe more. We could argue about that, but 1.5% return on the 10-year treasury. So what we see all around the world is that the inflation is running much hotter than the safe return on investments. And what does that mean? It means that if you're an average person saved up 100 grand, you're just losing the difference between those two numbers every year because it costs you more and more to live, and then you can't get a return on your invested dollars. And so what do you do? Well, I'll tell you what we've done. I mean, I've been at this a long time, and what I've decided to do is to buy as many shares of Metalla as I can possibly handle, which, it seems like a lot. I mean, it's a relative amount, but the reason why, and you notice I haven't sold any stock, is because what I see happening is at some point the hot SPACs, the hot coins that are being offered, pizza coin and garlic coin and all these things that come out every day. There's 30,000 of these coins that come out. Everybody that I hear tell me about these coins is explaining to me how it's very cheap, the coin, and then it's going to be very expensive, and they're going to sell it to someone else, and they're going to make a bunch of money. It's going to change their life. I hear this all the time. Well, once this stops, and all of a sudden, pizza coin is hard to get rid of. People turn around and they say, "Well, what do I do? What do I own?" There's going to be one move in the gold market. That's it. Just one move. And we're not talking about like $10,000 gold. We're just talking, let's just say 2,500, 3,000, whatever. There's going to be one move. It's not going to go somewhere and then come back and give you a heads up that, one is, oh yeah, well, we sorry you missed the first ride. We'll come back, we'll get you, we'll go again. That's it. And Brett's talking about mergers and acquisitions. If you're paying attention to the business, there's companies that are buying up small royalty companies. The bigger companies are struggling to get deals done. They're doing kind of more unique and different things they haven't done before with other metals. There's a lot of interesting things happening. There's a bit of a scarcity effect going on. And as we all know, the number of ounces of gold produced is going down. The amount of money invested in the gold market to find new gold is going down. So there's less new gold mines coming online, and interest in gold has been zero or less than zero. But meanwhile, there's not that much gold available. So you have this setup where jittery, impatient, novice investors that tend to make a little bit of money and then lose a lot of money are very frustrated and not interested. But the Richard Russell type thinking person, the person that realizes that to create serious wealth, you have to think carefully about where you put your money, and you have to be very, very certain about what type of risk you want to take on, because you see something coming in the future and you want to be prepared in advance for that. And you want to own something that will inflate like a gigantic balloon that starts to inflate, and then as it inflates more and more, it creates this surge in value that would not be possible from any sort of work effort in life. That's the thing that it's very difficult for people to see, is that when you find this opportunity to boost wealth in this way, you realize that it only goes one time. And it reminds me of, I bought real estate in 2010 in Florida, and it was a very, very scary time to buy real estate. People were very, very negative. Even the real estate brokers were negative. They were saying, you should really think twice about this. It was not an exciting time. However, you're buying rental real estate at times $10 a square foot. And so as that goes, you don't get the chance to go back and buy it again. Nobody says like, well, sorry, you missed it. Let's rewind the tape and let you go again. You had to have a hunch. You had to be confident about that hunch. And then you had to be prepared to own whatever you bought, even if things don't get better. And so the reason why I say that is because obviously I'm fond of the company where I'm a director. I'm fond of the team that's talked to you today. Sitting on the board, I've handpicked that team. I'm extremely happy with them. When I meet with them in person, I'm always thrilled to watch them grow and to tackle the business and to go out and do my bidding, because I'm a shareholder. And so to be able to choose the team that goes out every day and builds the value of my personal investment is really thrilling. And so, I'm happy that everyone is here today, and I hope that you'll get a sense for what we're doing and what we're continuing to do, regardless of day-to-day jittery fluctuations. We have a plan, and we think it's a good plan. When the facts change, we try to change as well. And so we hope to carry through the end of this year and into next year. And you'll see more and more that during this period of choppy markets, we were up to something. and that something, that fundamental kind of effort every day pays off. That's our hope for this time. So I hope that gives everyone a sense of what we're thinking, and I'll turn it back over to Brett.
Thanks, Evie. So we'll run through some of the questions here on the Q&A. If you have any questions, please type them in now. I don't think we'll be able to get through all of them, but we'll do our best here to get as many as we can here. First question that I see here is on the BD convertible loan. Currently, we've got 8 million. We recently drew an additional 3 million to fund the Castle Mountain acquisition. And the question was really around kind of the 8% rate and the expense of that rate. And I think one thing to point out about the BD convertible loan is that when those shares convert at the time that we issued the convertible loan or increased the convertible loan, those shares were priced at a 20% premium to the 30-day VWAP. So even though there is an 8% cost, we're able to raise capital at an equity price that's 20% higher. Oftentimes, if you're going to the equity markets, it often includes even a bigger discount to raise that capital, which could inevitably be a 30% spread difference between the capital that we can get from BD and the capital that would be available through the traditional means of equity financing. And so that's really important. And it's also important to note that, out of the millions of dollars that we've had through BD Capital, they've converted everything so far outside the 8 to equity. So again, it's just a tool in the toolbox that we can use specifically during times of when the share price is low or when the share price is high. It can work and give us, more tools in our tool shed to be able to make sure that we're doing our best job at when we're acquiring these acquisitions to do them on the most accretive way possible. We've got another question on dividends. Again, dividends is something that's always at the top of our mind. Our asset portfolio right now is really strong enough at this point to be able to start to consider turning the dividend back on. This year, especially in 2021, we like I said earlier in the presentation, this has been our biggest year. So we really had to reach for all the capital available to be able to get these deals done and inside Metalla. And we feel that this year especially we pushed extremely hard because we kind of saw the way that the sector was moving. We kind of realized that over the next couple of years there may be more competition. It may be more difficult to get these assets specifically at the accretive prices that we were buying them at. So we really made a push, and we feel that delivered a significant amount of more value than the capital return. But the capital return is on our minds. We evaluate that every quarter, and we'll continue to do that and hope to initiate that back on here in the not too distant future. We have a question on, let's see here. Peak silver. We can't look. We're bullish gold. We're bullish silver. Just personally, I think that there is obviously a very significant macro setup on precious metals. So we are positive on that. That being said, when we're doing transactions, we do not price higher metal prices. We use, for the most part, consensus pricing, which is usually a tailed off lower price. We've got a question on M&A. Again, hostile type of potential acquisitions. As I noted in kind of my opening remarks of this webinar, I believe Metalla is in just a great position of strength to navigate over the next 2 years. I think that the next 2 years will present some pretty amazing opportunities for us to grow the business. And so it's good to be ready for it and to be proactively thinking about how how you're going to be able to operate in new environments. And so I think Metalla has done a really great job doing that, and I think we're again in a very significant position of strength going forward here. We've got a question on the share price. We, along with the rest of the sector, have experienced a consolidation. The gold price has been in consolidation for a little over a year now. And year to date, our stock, I believe, is down, right around kind of 40–50% range. Now, it's important to understand the context of that, because if you just go back 12 months, I believe we're almost flat on the last 12 months, which is probably, I think, better than the majority of the sector. And if you go back 2 or 3 years, we're up hundreds of percents from the early days. And we've actually had in the last 5 years a number of pretty significant corrections as we've built our business. The market doesn't always line up exactly with the value of the company. Sometimes it overshoots, sometimes it's way below. And what I can say is right now, this is the cheapest that we've seen our stock in the last 3 years. So if you didn't buy the stock at $2 a share, I'm telling you from a valuation perspective today, it's just as or more of attractive as it is today as it was back then. And so that's the opportunity, and really that's the opportunity going forward, potentially as we continue to grow our business. We think there's lots of great things ahead of us here. We've got a question for EB on any potential thoughts on targets for what the gold and silver price will do over the next 6 months or 12 months. Near term, long-term targets.
I'm surprised it's below 1,800 right now. We were talking the other day about 1750 all of a sudden turned into this magnet where the price would not leave 1750. Today up $35 or so, $33. We broke through that. So what I would say is that it's too hard to bet right now, because once we break through this, I think we're going to see these $20, $30 days in rapid sequence, and we're going to move up over the 2000 level and into a new zone, and we're going to have a pretty long runway of people that are not exposed whatsoever that then have to get exposed. And let me give you some idea. We just went to the Denver Gold Conference, which is the biggest, I think it's kind of like the most important gold conference to go to, because you have lots of face-to-face meetings with all the different companies are there. And it's very executive oriented. It's not really a retail conference. And there was just nobody there. There was nobody there. And the CEO of Barrick Gold, who I'm quite fond of, spoke, and I'm looking around, and he might as well have spoke at 3 o'clock in the morning. I mean, there's no one in there. And so that tells you something. There's no institutional investors. There's no to speak of. There's no hedge funds. It's not popular. No one owns gold. So I think the reason why you have to wait for the breakout is because it could be today, and it could be in a month, and it could be in 6 months. But when you see it break out of this short-term consolidation, because really a year ago in August we were at all-time highs, and the chart said we would keep moving. I mean, there was a big argument for 2,500 at the time on the chart, and so we consolidated there. So this is very short-term. It feels long-term. If you watch it every second, it feels like an eternity, but really it's only a year. So I think when we turn out of this, we look to eclipse the old high and break into new territory.
Thanks, EB. We got a question on color of the current deal environment. As I said earlier in this presentation, we have seen a very significant increase in the competitive environment for the good assets that are out there. We as being really having a first mover advantage in the existing market, we've built strong relationships with a lot of these holders, and that's really what the business of buying existing royalties is all about, is having the relationships and the track record and the high quality portfolio. That's what gets you these deals. That's what allows Metalla to go out and buy these things. There's no database advantages. There's no you're not lifting up rocks and getting lucky. It's just consistent, the consistent track record and the consistent ability to be able to harvest. And we're moving into a stage of our business, or we've been in really a stage of our business over this last year where we've been able to harvest a lot of these great opportunities. And we feel like we're in position to continue to do that over the next couple of years. And so I think we're in a good spot relative to some of the peers in this current environment. We'll do one more question here. And we got a question on the profitability of mining companies versus royalty companies. And what I can say to that is, obviously royalty companies have great margins. Sometimes the margins are upwards of 100%, because depending on what the royalty is, you're taking that cash flow right off the top, and that cash flow is in perpetuity and it's free carried. There's just no real way to compare the mining investment in my opinion to the royalty investment. It's truly just such an amazing asset. And when you can take these assets and you can span them across 70 different projects, that you have the largest mining companies in the world putting in hundreds of millions of dollars to the assets that you have exposure to, free carried, providing significant organic growth. There's just no better business to be in. And this is what we've been able to build. So we're very excited again for this next year. And we thank you all for your support. We'll continue on here.
And Brett, make sure people understand the mining. It's a big mistake to use the same analysis tools for a mining stock as for a royalty stock, because you miss something that's super important. If a mining company has 50 million ounces of reserves in the ground and they're mining 5 million ounces a year, we all know that they have 10 years left to mine and they're totally out of inventory. So they got to either buy some wine or find something new, and all this is how it goes. And during that time, the cost of oil and Caterpillar bulldozers and labor and all these things is variable. So it can go up. So the mining business is really a complicated widget business. In a widget business, you put things together and sell them, and you have to make money on every dollar of revenue. And so that's the mining business. It's quite profitable right now. I mean, a lot of these companies have 35% gross operating margins. It's pretty nice. I mean, that means $600 or $700 an ounce that they're making, top line off the gold sales, which is pretty good when you have a lot of them have no debt too. Okay, so in my book I wrote. By the way, this is available in hardcover now from Amazon. Recently available in hardcover, and it'll fit in a stocking. Just so everyone knows. So I explained that the way to value the royalty company is totally different, because the royalty business is not a widget business. It is looking at a PE ratio for the royalty business is absolutely useless. And the reason why is because you have a totally different type of accounting. What happens is you've got 30 years of exposure, 40 years, whatever the case may be, to ounces of gold that are going to come out of the ground that you don't pay anything to get them out of the ground. So there is no, put the widget together and sell it. There's just sell it. And so everything that you've spent is on the front end. And I could compare it to real estate, where if you look at a real estate trust and you look at a PE ratio, it's very confusing because there's a depreciation component that goes into amortizing the cost of the royalty, similar to owning an apartment building or something. And so the way to look at these businesses, that's the bigger royalty companies, smaller, whatever, is the price compared to net asset value, because the net asset value is all the ounces of gold in the ground combined into one, compared against the stock price. And so that is the metric. And in my book, I wrote in very specific detail about where to find that metric, how to use it, and how it's a very fair way to rank companies, because every ounce of gold that comes out of the ground for the royalty company is gone. Okay, so that reduces the net asset value. And so that ratio keeps tabs on what a company is worth. And consider that instead of a PE ratio, because the PE ratio will be very deceptive. And in the end, it won't tell you anything that helps you determine if it's a good time or bad time to own the stock. The net asset value is the key metric. And it's not the case so much for the mining companies. It's very different.
Yes, and again, this is just an incredible opportunity right now, because we've had a really a good gold price. I mean, $1,700, $1,800. I mean, the balance sheets of the major mining companies is in the best shape the best shape really I've seen in the last 2 decades, and yet at the same time, we're seeing contrarian signals of maximum pessimism in the gold equities. And for whatever reason that is, it's hard to pinpoint exactly why that is. But what it is an opportunity. It's an opportunity because you've got an incredible macro setup. You've got a pretty good gold price and you've got equities that are being mispriced. Along with that, even the royalty companies, the blue chip royalty companies as a group are all, I would say, the good ones at least, are very attractively priced at this moment. And there hasn't been very many times for these types of setups. So, again, great opportunity. This is the best entry point, I believe as I said before, we've had in the last 3 years from a P to NAV perspective. And, both myself and UEB have been buying in the market at higher prices, as we, didn't even think it would make it down to these levels. But I mean, they're just incredible levels to be able to capitalize on over time. So with that, we'll conclude our webinar. Thank you all for joining us again. And we hope you have a rest of the good evening. Thank you.